John, always fun to have you in studio talking about data as always. But the number we're going to talk about today is the 61.6% of commercial tenants in good standing.
It's a very weak number still, Michelle. To give a bit of context though, it is a significant improvement from about 50% in the second quarter of last year. That was the lockdown quarter. A lot of tenants' incomes were totally stopped, 100% virtually, and that was a really tough time. So significantly better, but I think the fact that we've only got to 61.6 when we should be looking at probably somewhere nearer to 80, high 70s in a normal situation, just shows exactly the extent of that lockdown knock on the economy and the lagged impact still coming through. Tenants will take quite some time to fully recover from that knock to their incomes through lockdown.
You're absolutely right, John, because at the depth of the lockdown, only 1 in 2 tenants were managing to keep up with their commercial rentals on a monthly basis. And we've had a very slight improvement, 12%, but nowhere near what we need for our landlords to feel comfort, because it's a double whammy, both the non-performance in payment of tenants as well as the high vacancies.
Yeah, and I think that these numbers say a lot about the economy in general. So we're back in positive growth territory from a GDP point of view. You would expect that after you took a big knock in the second quarter. Coming off that low base, you've got to grow positively. But our expectations at First Rand are that you might take a few years for GDP level to get back to where it was in 2019. And the slow pace of tenant recovery back to full recovery, which would be somewhere well into the 70s, nearer to 80s, that could take some time as well.
What's your prediction in terms of the number of years that we're looking at to move forward?
Well, I think the problem is that we don't go back to a well-functioning economy. We still go back to problems, the old problems, the structural problems to this economy, the lack of performance and that sort of zero growth environment, which already was starting to weaken the tenant performance from a few years ago up until pre-lockdown levels. So that's what we go back to, and the squeeze then sort of remains on the tenant population. But I think during the course of this year at least, we should see I think we should get back to around about 70% of tenants in good standing by the end of the year, which isn't a great number either. But I suspect that by then we should be at about 70.
Although there are some tenants by sector who are performing at 70%, are office tenants.
That's an interesting one. Yeah. So the office tenants had the best performance from a percentage in good standing point of view of the 3 major sectors.
During the lockdown period?
Yes. During most of last year, in other words. And after the lockdown, they're still the best performing of the 3. At 71%. In the middle is industrial, and the weakest one is retail at 61%. But there's a trick to it. Office properties' troubles are not about tenant performance. They've performed better than the retail tenants, who really got a lot of their sales income just shut off as centres had to just about shut down. But it's about the lack of demand for office space. I do believe that office property is going to perform worse than retail during the course of this year. It's not because of bad tenants, it's because the tenants are cutting back on their office space noticeably as a result of pressure which hasn't led them into trouble, but it's financial pressure nevertheless, as well as the success of this forced lockdown work from home experiment. It's worked very well. It's got its shortcomings, but it's forced everybody onto Teams and Zoom and to work remotely. And it's worked probably better than expected for many, and we're used to it now. And a lot of companies, I think, are starting to see that they can cut their costs significantly in terms of office space and scale down on that in a tough financial time. So that's the problem for office space. The office property sector has probably got bigger challenges than the retail property sector now, even though it doesn't show in the tenant performance at the moment.
Not yet. And hopefully not in the future, because ultimately tenant performance is based on how tenants are paying. And yes, you may have less tenants in your office space, but the performance of the tenants as a result of their payments should continue to be good.
Well, yes, you probably have less tenants, but you're going to have a higher vacancy rate. And of course, with that comes an increase in tenants' bargaining power And so already, if you look at Roode and Associates data for the fourth quarter, you've seen around near to 5% year-on-year decline in office market rentals. So it's a lack of demand for office space that's weakening the office property sector more than a weak tenant population, which you find in the retail sector, for instance.
Right. And what do we think about the retail sector then?
Well, it's coming back. As the months go by, you see an increase in that percentage, but it's only up to 61%. I think there you probably will also have an increase in vacancy rates as some shut their doors. We have had in recent years, and there's probably more to come, but probably not as severe a vacancy rise as what's been happening in the office sector as of late, and probably likely to continue. Retail, but there's retail and there's retail. There's the more basic necessities of retail and centres that are dominated by that. The food shops, the basic groceries and that's better. And that's almost, if you look at those retail sales number, they round about back to zero in real year-on-year terms. So, and never took such a significant dip. But centres that are more dominated by the highly cyclical clothing, footwear and textiles, that's a point of pressure, and then particularly if you're dominated by the entertainment and the restaurants. You look at Stats SA numbers for restaurants. I mean, they're still well down year on year, partly because of social distancing requirements, but partly also because I think of household incomes that have taken quite a sizable knock. So eating out and all those luxuries, and going on holidays for one as well, and any non-essentials get put on the back burner. And with regards to clothing and footwear, a lot of things can be postponed. So that gets put on the back burner in financial pressured times. So it depends on the type of centre. The more essentials a centre deals in, probably the better.
And then the fascinating outcome of our storage tenants.
Yep, 90% of storage tenants in good standing. Isn't it fantastic? That's a little niche that's been doing very well for itself. Storage is an interesting one, and I wouldn't say it's recession proof, but it seems that it's a more affordable form of property, that's for sure. And when households are shutting down now in tough financial times, what often happens is a household in the residential rental market shuts down. In other words, they cancel their lease and they move back in with mom and dad until such time as finances are better. What do you do with all your stuff? Storage space, possibly. Businesses temporarily shut down or scale back because of financial pressure. What do they do with all their equipment and stock and whatever it might be? Storage space. So the storage market, it did take a little bit of a knock during last year, but its tenants have outperformed the big ones for all through that period, and yeah, it's in for many instances, I think, a much needed form of property during tougher economic times.
Folks, that is all we have for today's session, talking about tenants in good standing, the tenants' rental payment profile for commercial tenants for quarter 4. John, thank you very much for joining us. Any last words for our audience today?
I think the only thing is we have to be realistic about timeframes. Lockdowns are virtually done. There are still restrictions on restaurants and social distancing. There are restrictions, but I think but by and large we're very open. We're level 1 lockdown, but I think we've just got to be realistic about the time frames coming out of this. That was a very big financial knock for a lot of businesses, and of course a portion of the economy's production capability has shut down permanently. It's, in other words, companies that have gone under. They don't just get replaced overnight by new companies, because business confidence is poor. So existing companies don't just go out and expand in capacity overnight to fill the gap left by those that have shut down. So it's a long road back. And if you look at tenant performance, if you look at full economic recovery, that can be a few years. It's not something that just is going to happen in the course of this year. Yeah.
Exactly.